Hello learners, welcome again to our session today. In our class today, we are going to introduce the backbone of financial accounting. This is actually the fundamental. This is actually the fundamental concept of financial accounting. This is the basis of financial accounting. So we are talking of accounting equation. We are talking of accounting equation. Accounting equation. This is the basis of financial accounting. You can't do financial accounting comfortably if you are not good in financial, or rather in the accounting equation. Or rather, you can also not proceed with accounts if you're not good in accounting equation. So our concept of today, my good students, we are looking at what? Accounting equation. Accounting equation. Accounting equation is a concept that Mwalimu will want to summarize in our class today. So when we are talking of accounting equation, my good students, basically we are saying that this is a basis of financial accounting. That is what we should understand, that at any given point you're talking of accounting equation, I say that this is the basis of financial accounting. Basis of financial accounting. This is the basis of financial accounting, which you'll find that at this point, this is a backbone actually of financial accounting, just in a very summary manner. So you'll find that transactions basically are recorded using the double entry system, which will be analyzing double entry system of accounts, whereby I'll be having one transaction will always be having two effects. There is an account that is going to increase, and there is an account that is going to do what? To decrease. This is what you're terming it as double entry, which in that case, Mwalimu is saying that we are going to look at that and you're going to summarize it very clearly. So you'll find that an account is the most basic accounting record. Probably you can be talking of accounting. Some of us, you don't know what an account is. So an account basically is a basic accounting record. It summarizes the increase and decreases in particular assets, liabilities, revenue, expense, or a capital item. This is what you're terming it as an account, because accounting is a process of recording, identifying and recording, right? So you'll find that recording these transactions, you're going to record them in what is known as what? As account. And this account basically will have an impact of either these items recorded, they might either be increasing or decreasing over the period of time. So you'll find that many a times it will be very key that we understand these items. So make sure that once you have this accounting equation, at this point I can confidently state that we are now being introduced to financial accounting clearly. So accounting equation normally tend to state that our assets will always be equal to capital plus liabilities. Assets will be equal to capital plus liabilities. Assets will be equal to capital plus liabilities. This is what we normally term it as what? Accounting equation. This is the accounting equation. You can term it as bookkeeping equation. These are basically one of the main bases of financial accounting. For us to understand that our assets will always be equal to capital plus liabilities. And this is what will be represented in our statement of financial position. Anytime we are supposed to prepare our statement of financial position, remember we looked at this under elements of financial statements, where we say that one of the elements in financial statements is statement of financial position, which was used to be known as balance sheet. So at this point, you are saying that for us to arrive at our assets, basically, we'll be talking of our capital plus liabilities. And when you're talking of assets, basically, what do we mean? So I want us to analyze each and every component here, starting with what assets are. If you're asked, my good students, to state what an asset is, what can we say an asset is? What can we say an asset is? So take, for example, this case. At this point, you had a cash from your own cash, right? You've gone to a supermarket or a shop. You purchased a phone. This phone, you're going to say that this is my phone. I own this phone. So this is a resource that I can control. I can decide to take myself selfies. I can decide that this phone, probably I'm going to listen to music. I can decide that this phone, if I want to talk, I can talk. So long as I'm having credit, of course, I can talk for as long as I want. Meaning that it is a resource that it is purely under my control. Because in this case, I purchased this phone with my own cash. Or even if I was given as a gift, birthday or whichever gift I was given, it is mine, right? So these are resources that I can control. And the resource that you can control is what you are terming it as what? As asset. Let me not go there where some of you think I'll go. I'll not go there where we normally tend to say that maybe you have your wife in the house. Is that your asset? You have your husband in the house. Is that your asset? Right? I won't go there. I won't go there. I won't go there. But basically what Mwalimu wants to drive is that for us to understand what an asset is, basically, we are looking at a resource that you can control. I've given a good example of phone. So at this point, in a very brief manner, if we are to talk of assets, basically, we are looking at resources control now, bring this now to a business perspective. So we are talking of assets as resource controlled by a business. These are resource controlled by a business, resource controlled by a business, resource controlled by a business entity, resource controlled by a business entity or a firm, resource controlled by a business entity or a firm, as a result of past events, 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 for which economic benefits, for which economic benefits, for which economic benefits, for which economic benefits are expected, for which economic benefits are expected to flow to the firm, to flow to the firm, to flow to the firm. So take now in a business perspective, my good students. At this point, I have purchased, say, for example, a PC. I purchased a laptop or rather a computer in my office. I'm using this computer to record these videos. In this case, you'll find that, first of all, it is as a result of past event. I went to the shop and purchased this computer. So that is past event, for which economic benefits are expected to flow to the firm. At this point, now I'm using this computer that I purchased to produce these videos that you guys are going to purchase from now Darasa. So you'll find that it is as a result of past event. I went to the shop and purchased this computer. Now, as at the end of the day, now these computers are under our control. They are under the control of Darasa. So you'll find that Mdarasa is using these computers to generate revenue. Is using these computers to generate revenue. And that's why you are watching this video, because you've purchased these videos of ours. You've purchased this package. That's why you're watching this. And in that case, you'll find that that is a revenue that has been generated to the firm. So you'll find that an asset, you should understand, first of all, that it is a resource controlled by a business entity or a firm as a result of past event for which economic benefits are expected to flow to the firm. So this is an asset that you purchased. You purchased your phone, probably. You are doing online marketing. In this case, you purchased your phone. That is an economic, that is a past event. Now you're using that phone to generate revenue from the online trading that you're doing. So you'll find that this is what you're terming it as an asset in a very simple manner, where we've said that a resource controlled by a business entity or a firm as a result of past event for which economic benefits are expected to flow to the firm. That is what you're terming it as an asset. Now, it is very vital for us to understand that these assets are always categorized into two. It is very vital for us to understand that assets are categorized into two, where we normally tend to talk of, number one, assets. You are saying that assets are classified into two. Classification of assets. We are saying that assets are classified into two. These are, number one, non-current assets. And talk of number two, we normally tend to talk of what? Our current assets. So we are saying that assets are classified into two, or rather classification of assets are into two. These are non-current assets as well as the current assets. So to that point, let us dissect the first component, which in this case we are terming it as what? As non-current assets. So I'm having non-current asset. So we are talking of non-current assets. Anytime you're talking of non-current assets, my good students, basically what should come at the back of our mind? So non-current assets in a very simple manner so that we should be able to understand. You will find that these are assets acquired by the business to assist in earning revenues and not for resale. So number one, we are saying that number one component for us to understand the non-current asset, and this is a very key concept. I don't want you guys to cram. I want you guys to understand the whole basis from scratch. We are peeling the skin of this item, not peeling back the mask, right? We are peeling the skin of financial accounting. So in this case, you're saying that non-current asset, first thing that you're saying that you should understand is that they are acquired by the business to assist. They are acquired. They are acquired to assist. They are acquired to assist. They are acquired to assist. They are acquired to assist in earning revenues. In earning revenues. And not for resale. And not for resale. So these are items, or rather these are assets acquired to assist in earning revenues and not for resale. The main purpose of me purchasing this computer that you're using maybe to do these videos is to assist the business to generate revenue. So we are not selling the computer that you purchased. The motor vehicle that I purchased, probably if my business is not of selling motor vehicle, I'm purchasing the motor vehicle. This car is for the business to assist in moving from one place to another, of course, and this movement basically is in the course of generating a revenue to the firm. And again, one other key concept that you should understand in non-current assets is that they are normally expected to be in business. They are 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 expected to be in business for more than one accounting period. for more than one accounting year. 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 So basically, you will find that I have purchased these assets, and these assets will be expected to be in the firm for more than one accounting year. They will be there for as many years as possible. So long as they are in existence, they'll continue to be there. So first thing is that I'm purchasing this item not for resale, but to assist us to generate revenues. And again, you also say that these assets are expected to be in the firm for more than one accounting year. That is one concept that we should be able to understand. Then one person will ask, Mwalimu, what are the examples of non-current assets? So looking at the examples of non-current assets, my good students, looking at examples of non-current assets, I know by now you can give me whatever that you are owning, which is going to assist you to generate revenue, it is going to be there for more than one accounting year. For example, like what? Mwalimu has been talking about computers. So we are talking of maybe computers, for example. Number two, we are talking of maybe land and buildings, if we do have. If I'm not selling aspect of fixtures, furniture, and fittings, so talk about fixtures, of course, furnitures, and fittings, furniture and fittings. Talk about maybe motor vehicles, etc. So basically, you find that these are, so long as you are able to identify an item that is in the firm, which is going to assist the firm to generate revenue, or an item which is going to be there for more than one accounting year, and it is purely owned by the firm. So you'll find that this is what you're going to term it as what? As non-current assets. So that is non-current assets. Let us proceed to the second type of assets, because recall you say that under classification we are talking of two, right? So let us proceed to current assets. When we are talking of current assets, basically, what should come at the back of our mind, my good students? Current assets. So you'll find that basically current assets, my good students, you'll find that they are not expected to last for more than 1 year. And in most cases, they directly relate to the trading activities of the firm. So these are assets that are not expected to be in the firm for more than one accounting year. Assets that are expected to be in the firm, for not more than 1 year, Meaning that purposely, these assets, we are purchasing them with the main agenda of maybe resale at some point, or they are going to be utilized within one accounting year. They are going to be utilized. Yes, these are resources that we do control, but you'll find that they are going to be utilized within one accounting year. Say, for example, like whenever we are talking of, say, inventory, or rather, these are stocks, yeah? Common, right? So you'll find that for inventories, of course, I'll be selling this within 1 year, because they are purely purchased for resale. Not like non-current assets which are not purchased for resale. These ones are purely purchased for resale. So you're talking of inventory. Number two, maybe you're talking of cash in hand, or even at bank. So you'll find that basically for cash, of course, I'm going to spend within that year. Just take, for example, your case. If I told you you're having, say, like 100,000 today, Will you be having that amount for the whole year? Of course, it will find some ways to be used, right? In one or the other, it's going to be used. So it's not going to be there for more than one accounting year. So that's why you are saying that these are aspects or resources that you do control that are not going to be there for more than one accounting year. Say, for example, receivables. These are debtors, right? Receivables, or use it as, time it as debtors. Of course, these are, yes, they are owing us. So I'm having a right to do what? We do have a right to say that this is our property because you guys are owing us. So in that event, of course, these debtors, maybe in the event that you find some debtors who are kind of, they're just other ones, right? But mostly they will be trading within one accounting year. So these are what you're timing them as current assets. I wanted us to get a very clear distinction between non-current assets and current assets. So we are saying for us to have the assets. So the assets, basically, these are non-current assets and current assets. We must be having capital plus what? Plus liabilities. So we've analyzed what assets are. Let us also analyze what liabilities are. So allow me to erase here. Then we check liabilities and see what it entails. So that anytime we'll be talking of liabilities, basically, what must we always be able to recall? So these are liabilities. So talk about liabilities. Liabilities. Talk about liabilities. We've talked of assets. Now we are on the second part, liabilities. So, my good students, anytime you talk of liabilities, basically what should come at the back of our mind? Take, for example, the same case. At this point, you've gone to a bank, you've taken a loan, right? Yes, it is a cash that you're going to have. But as at the end of the day, you have to repay for that. That is not yours. So, you have created an obligation. So that amount is not yours, but rather in this case you've created an obligation, which is at the end of the day you'll have to pay for that obligation. So that is not yours, that is not yours, that is not yours. Like compare with assets where you say that these are resources that you can control. But for liabilities we find that basically these are what? These are just simply obligations that we are owing other people. That you are owing other people. So this is what you are terming it as what? As liabilities. So, in a very brief manner, anytime you talk of liabilities, basically normally term them as what? Obligations of a business as a result of past events. These are obligations. Talk about obligations. These are obligations. These are obligations. These are obligations of a business, obligations of a business as a result of past events, as a result of past events, settlement of which is expected to result, settlement of which is expected, settlement of which is expected to result to an economic, to result to an economic outflow, to result to an economic outflow, to result to an economic outflow from the farm. From the farm. So look at it in this case. At this point you've taken loan, which in this case that is result as a result of a past event, as a result of a past event, as a result of a past event. So at this point I've taken my loan, but I'm going to pay this loan, of course, in future. That is to say, it's going to result to an economic outflow I'll be paying this loan is going to result to an economic outflow to the business, an economic outflow to the business. So this is what we are terming here as liabilities. These are just obligations compared to assets, where we termed it as resources that we do own. For aspect to do with liabilities, these are obligations that we will be required to pay in future. So again, very important to understand classifications of liabilities. So liabilities are also classified into two. Number one, we normally tend to talk of what? Non-current liabilities. Non-current liabilities, commonly known as what? Long-term liabilities. These are long-term liabilities. And number two, we are talking of what is known as current liabilities, current liabilities, current liabilities, current liabilities. So for liabilities, we are talking of two: non-current liabilities as well as what? As current liabilities. Just like assets. Just like assets, just like assets, right? Just like assets. And Mwalimu is taking a lot of time here because Mwalimu knows that this is a very fundamental concept that we must have for us to continue with financial accounting without any challenges. So let us analyze what non-current liabilities entail. Let us analyze what non-current liabilities entail. Or let us analyze what non-current liabilities entails. So non-current liabilities, my good students, will find that we are looking at obligations that are expected to last or be paid for more than one accounting year. These are obligations that are expected to be paid for more than one accounting year, for more than one accounting year, for more than one accounting year. Take, for example, we have loans, long-term loans, 5 years loan, 10 years loan. These are obligations that will be expected to pay for more than one accounting year. That is what you're terming it as what? As non-current liabilities, or rather long-term liabilities. What about another component here? We are talking of current liabilities. So you'll find that for current liabilities, basically, of course, these are obligations that are expected to be cleared within 1 year. Obligations that are expected to be cleared within 1 year. Obligations that are expected to be cleared within 1 year. Obligations expected to be cleared within 1 year is what you're terming it as what? As current liabilities. Say, for example, we're having, say, like payables. These are our creditors. We have to pay them within 1 year. Talk about, maybe we are talking of aspect to do with maybe bank overdrafts and any other form of accruals that we'll be looking at. They are expected to be cleared within one accounting year. They are expected to be cleared within one accounting year. So basically, those are what we are terming them as what? As current liabilities. After that case, another key element to understand is what? Capital. Because we say that in our book, in our accounting equation, our assets will be equal to capital plus liabilities. And now we are dissecting this component one by one so that you must be able to understand clearly. So we've analyzed assets, we've analyzed liabilities. What about capital, my good students? If you're asked to define capital today, what can you say? Because nowadays, majority of the youth, they are always like, I wish to start a business, but I don't have a capital. I want to do this and this. It's only that limitation is capital. I want to do this. I don't have capital. So that's why Mwalimu is asking today that anytime you are talking of capital, then what do we mean? When you are talking of capital, what will come at the back of your mind then? Because now we normally tend to say that I wish to start a business, but the only limitation is I don't have capital. So what is this capital? So in a very simple manner, you'll find that capital basically is a residual amount on the owner's interest in the firm after deducting what? Liabilities from the assets. Or rather, it is just this amount that we use to start a business. These are amount or resources that we use to start with a business. These are what you're terming them as capital. Resources that resources used to start a business. Resources used to start a business. And it is from these resources that we are going to have our assets probably. That we're going to bring in our assets. That we're going to bring in all our aspects of assets which might also assist us to pick some obligation because we have collaterals, right? So you'll find that at this point, capital basically, these are resources that we normally tend to use to start with a business. So therefore, this will mark the end of our bookkeeping equation, accounting equation, where we say that now for me to determine our assets, remember assets in summary, current and non-current assets, I should be having my capital resources that we're going to use to start the business plus liabilities. These are obligations. This is what will give us what? Our assets. And later on, as we'll be looking at the format of statement of financial position, we'll find that it will clearly describe this bookkeeping equation. It will clearly describe the bookkeeping equation. So guys, at that point, now I believe I've given you the basis of what you need to know when it comes to financial accounting. So the train has already left the station. So kindly let us meet in our next session whereby we are going to clear this topic by looking at the users of accounting information. It is from topic number 2, or rather the next topic, that we're going to analyze now all these things deeply from source documents and all these other elements. So to that point, guys, thank you so much, and kindly let us meet in our next session. Thank you.